Okay, so I'm going to walk you through some sales transactions for a merchandiser who's using the perpetual method. So let's say they sold merchandise for cash of $100. We would record this or receiving cash, so we would be debiting cash for 100, crediting sales revenue for 100. But since we're under the perpetual method, we also have to make a second entry because we have to update what happened to our merchandise inventory. We sold merchandise inventory, our merchandise inventory account needs to go down since it's an asset. It goes down with a credit. So then that means we need a debit, and we have a new account under a perpetual system called merchandise inventory. So, I'm sorry, called cost of goods sold. So since our merchandise that we sold to the customer for 100, we had paid 60 for it when we bought it, right? We buy it at one price, we sell it at a higher price. So our second entry, we're going to debit the cost of goods sold account and credit the merchandise inventory account. What if we had $100, but the sales were on account? Okay, so we're billing the customer. So if that's the case, we're not going to debit cash. We're going to debit accounts receivable and credit sales revenue. We still need to make that second entry to update our merchandise inventory account. So we'll debit cost of goods sold and credit merchandise inventory. Next, we want to take a look at a sales discount. And this doesn't mean something's on sale. It means we're offering a discount because we want the buyer to pay the invoice early. And so we'll see that the terms of the sale indicate if there's a discount. So if the terms are 2/10 and /30, that means the terms for payment are they have to pay the net amount or the full amount within 30 days. But if they want to take a discount, we will give them a 2% discount if they pay within 10 days. And so under GAAP does not want us to overstate our sales revenue. And so under GAAP, the assumption is that the customer is going to take advantage of that sales discount. And so the sale really isn't going to be for 100. It's only going to be for 98 because they'll get to take a 2% discount. So we're going to record the sale as a debit to accounts receivable for 98 and a credit to sales revenue. We still have to make that second journal entry to debit cost of goods sold for our cost of the merchandise and credit merchandise inventory for the same $60 cost. Now, when it comes time to collect from the customer within the discount period, so they pay within 10 days, so even though the sale was for 100, they only have to pay us 98. Well, we had set up our accounts receivable as a debit of 98. So when we receive the $98 check from our customer, we'll just debit the cash for 98 and we'll credit accounts receivable. Now, let's say the customer didn't pay us within 10 days. And so they have to pay us the whole 100 by 30 days after the date of sale. So then we're going to get a check for 100. So we will end up debiting cash for the 100. We'll credit the accounts receivable for the 98. We're not going to credit for 100 because the balance is 98. When we recorded the sale, we recorded it net of the discount. So we recorded it at 98. So now when we credit it, we can only credit it for 98 because we want it to reflect a zero balance. The $2 is going to be sales discounts forfeited, which we show as part of other revenue or other income on our income statement. The other thing that gets kind of tricky is sales returns and allowances. So customer returns something just because they overbought or they return something because it's damaged. Okay. We need to record that. And that's not really a sale. If they return it, it's not like we really sold it. And under GAAP, as I mentioned, our Financial Accounting Standards Board, when they put together GAAP, they don't want sales revenue to be overstated. So they're going to require us to estimate the sales returns because again, we need to be recording our sales revenue at the amount we're going to actually realize, the amount that we're going to actually be, getting from our customers. So what we have to do at the end of the period, we have to estimate the amount of sales returns. Okay, so what's included in our sales revenue that's really going to be returned. And so you'll look at your past history and see what percentage of your sales revenue got returned, and maybe adjust it up or down for what's going on in the economy. But we'll work up and estimate a percentage. And so here's an example. Let's say the company had 20,000 of sales. The cost of goods sold for those sales is 12,000, and they estimate 3% of our sales are going to get returned. So 20,000 times 3% is 600. So 600 of that sales revenue really isn't sales revenue because the customer is going to return it. So we need to reduce sales revenue. We know sales revenue has a credit balance, so we're going to reduce it by debiting it. So debit sales revenue for that 600. And then we're going to credit refund payable because we're either going to have to give them cash or we're going to have to reduce their account receivable when they make the return. Now, the other piece is we have to adjust our merchandise inventory. So there's goods out there in the hands of our customers that's going to come back to us. And so we need to reflect that as merchandise inventory. Plus, we need to take it out of cost of goods sold because it's not really sold. So 3% of the 12,000 will give us 360. So we feel there's 360 merchandise that's out in the hands of customers that's going to be brought back to us. So we're going to make a second entry. We're not going to debit merchandise inventory because that account shows what we actually have in hand, what we're actually possessing. We're going to put it into an account called estimated returns inventory. This is going to be treated as an asset account as well. So we'll debit the estimated returns inventory, and then we'll credit the cost of goods sold because we want to take that 360 out of cost of goods sold because it's not really sold. We believe we're going to get it back at the start of the next period. So I know that's a little bit tricky. Then when it comes time for a customer to actually make a return, so here's a situation: the customer returns merchandise that they bought for $75, but our cost of that merchandise was $60. Well, when they bring it back, we're going to debit that liability refund payable for the $75 and credit cash, or if they brought it in, or if they returned it before they paid for it on account, we would credit accounts receivable. Then we need the second entry now because we're going to take that $60 and we're going to put it into the merchandise inventory account. We're going to take it out of that estimated returns inventory, put it in a merchandise inventory by debiting merchandise inventory 60 and credited estimated returns inventory 60. So I know the discounts and the returns are a little bit tricky. Hopefully this video helps.